Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All righty, that was fantastic. So, how is everybody doing today? Are we having fun? Are we enjoying the big drop and the recovery and all that crap? Interestingly, they just announced apparently a 2-year extension of the budget, which I found very strange, but considering there's an election this year. So no government shutdown now for the next 2 years, and the market went down on that. I find that really odd. Usually anything like that shoots the market up, and even though we're already up, it was kind of weird. Anyway, you missed the big excitement before. We just in the chat room, we did the natural gas trade. It went from it shot right up here. It's nice. On the NG, it's actually more severe. Where's NG? Oh, I can just do this. On NGV8. NGV8 is more subdued because it's long term. But NG had a wild little ride. See, he just went flying up and went all the way up to there. Anyway, so that was a good trade. What are we looking at? And the index is, well, you know, look, we said the S&P would test around 2,700, and that's where it is. And that's going to run up to 6,600 on the NASDAQ, 25,000 on the Dow. These are nice round numbers, and 1,500 on the Russell. So we have some really nice numbers to key off. But the most interesting trade at this very moment is gasoline, which is testing 175, and that is a fun place to play gasoline. So let's take a look at those charts. Oh, the dollar. I forgot. Sorry, do I have that out? Yeah. Oh, here's the closer. So, okay, the dollar. Nice day. $6,000 day for the dollar on mine. This is the same ones we've had forever. Remember, they were down 10,000 at one point. Now they're up 12,000. Now, I should have cut back to 4, and I'm kind of tempted right now because this is obviously we're hitting resistance at 90.25. But I'm kind of in it for the long term with conviction. So I guess the one thing I should check is when this thing expires, because if it expires, I should get out of it anyway and roll with the contract. So let's take a look at the contract length. You should always know your contract lengths, by the way, because you know sometimes you accident. Oh, there you go. See, there's the problem. I think I'm not sure which ones I'm in. Am I in DX G8 or am I in DX H8? I'm probably in G8. If I'm in G8, I should get out. There's not really a clue on that. Let's see. Trade. No. Active trader. March. So I'm in the March contract. So actually I have 30 days, I think. Yeah. Okay, I have 30 days. So I don't need to get out. I don't have any pressing urgency to get out. But you always gotta check when you're in these contracts. you should just have a pretty good idea of when they expire. These say March, 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 so they do say March. That's why I wasn't worried about it in my head, but I knew that there is a dollar contract expiring shortly, so I wanted to double check. It really sucks if a contract expires on you because you get forced out of it, or you're forced, or they cash it, which is even worse. So you always got to make sure you know your rollover dates. Anywho, be that as it may, so the dollar is my immediate concern. See, in the grand scheme of things, let's look at a weekly chart. This is nothing. This isn't even a bounce yet. You know, we assume 90 is a line, like it was an overshoot. At my theory, it's an overshoot of 90 on the way down. And coming down from 95 to 90 is 5 points. So a 1 point overshoot, that's perfectly normal. Come back up. We should get at least a point up is a weak bounce. Another point up is a strong bounce. Right about here is going to be the strong bounce line. I don't see any reason the dollar wouldn't bounce back to the strong bounce line at 92. That's like another $20,000. So I'm not too keen on getting out of it for real. But on the other hand, as a day move, this is huge. This is a huge up move. I don't know how well you can see it. You don't get a lot of green candles on the dollar bigger than this. And when you do see them, like here's one, then flat, here's one, red. I mean, you really ought to look for them. Here's one, but we gapped up the next day. Here's a huge one, but flat. Another big one, flat after that. But sorry, this big one, and then it went like that. Well, more to the point, though. See, here's the thing. Here's what I'm worried about. I'm worried about this. See what we got here? Same thing here. We had a spike down, came right back, and then crept up for the, for basically the strong bounce. And here too, spike down, big move, little flat, then big move up. I don't want to miss the big move up. I'll be really pissed if I do. On the other hand, I don't want to get hit with a reversal when I'm doing so well. So anyway, decision though is I think I'm leaving it. I see nothing on the horizon that makes me think the dollar is going to be weaker. I think the Bank of England has a decision this week. They're not going to do anything. They're not going to tighten. China's in no position to tighten. Japan just basically loosened. I mean, Japan just said, we will support negative rates forever as far as the eye can see. So what's going to make the dollar weaker? Why should the dollar be weaker? I think it's unnaturally weaker here. I don't think there's any good reason for it. So I'm not inclined to take it off, even though it's running amok. I mean, you make $6,000 move in a day, you kind of should, and especially when you're hitting your support zones, your resistance here. It's very unlikely the dollar's going to pop through that for the day. But again, it's probably going to come back to 90. It may even go back down here, may even come back down here. But on the whole, we're making the progress I want to make. When you zoom out a little bit, let's look at the daily chart. Hello. See, we're making the progress. So had I gotten out here, I would have been stupid, right? I would have missed out on a lot. So it's making the progress I want to make, and I don't see any reason it's not going to get back to this line. But it's going to take a while. So you have to balance that out with saying, well, hey, look at here's a run. Now, look how far of a run I'm looking for. Two-point run, right? So here's a 2-point run. It went up like this, pulled back a bit, then it comes up, then it pulls back a bit, then it comes up. So would I have been better off if I cashed out here and came back in, and then cashed out here and came back in? And even if I cashed out here and waited, I could have come back in and still caught the move up. Oh, hang on. That's rates. Let's see what they're doing. This matters.
Good afternoon. This is Bill Wagner from the Mortgage Market Guide.
It's a tape.
1:06 p.m. Eastern Time. Sorry for another call. Unfortunately, mortgage-backed securities ticked down to their worst level again. This just after a 10-year note auction, which apparently didn't go very well. So we're down 16 basis points, but we were higher earlier this morning, and we're drifting down to the lows. Not a good day. At the same time, we're seeing stocks back in positive territory after opening lower. So you need to lock, protect yourself.
Stocks are falling fast.
For the worst. We're watching the yield on 10-year note tick up to 282. It was just 264 just the other day. So it's yield is ticking back up. You need to protect yourself. Of course, if anything changes, we will get back to you. Have a great day.
That's what he's saying. So he's saying basically the rates went from 264 to 282. So we're having a bad day, and that means rates are we're basically bottoming back out on the rates. On the bonds, and that means rates are going higher. We're going to retest this area over here, and that's back. I still have the subscription from back when I was in the real estate industry. We used to care about the rates every day, so they give you alerts in case there's any changes. Anyhow, so basically they're basically saying that the bonds are falling apart. Yields suck. We just had a bad auction. Nobody's buying the notes. If the central banks aren't buying the notes, nobody's going to buy these notes at these prices. Nobody's stupid enough to hand over money for 10 years at 2.5%. It's not worth it. There's no chance inflation is going to stay that low. And not only that, though, but the Fed is telling you at the end of this year they're going to be at like 2.5%, 3%. So if the Fed, not this year, at the end of this year they'll be 2.5. Next year they'll be in the 3s. So if the Fed is going to be at 3, and they're telling you that 1 year from now, 2 years from now, they'll be at 3, why on earth would you want a 10-year note that's at 2.5? You're guaranteeing that you're going to lose 5% of that money. Your note's going to get a 5% haircut. What's the point? It wipes out all the interest you're going to collect for 2 years. You just wait. There's no reason at all to buy these things. So that's a big problem. That's gonna mess around with the stocks too. So we'll see what happens. All right, where were we? Dollar. So anyway, so I firmly believe that the dollar is going to keep going up. Now, sometimes when the dollar gets stronger, if everybody thinks that nobody believes the dollar is going to get stronger, it's only me. That's why I'm making so much money on the bet. But if everyone thinks the dollar is going to get stronger, then they'll buy the bonds, because you're buying the bonds priced in dollars. And if you think the dollar is getting stronger, then it's good to have something held in dollars. Even if the rates aren't good, the dollar appreciates. But nobody actually believes at this point the dollar is going to appreciate. So that's a problem too. When Trump and Mnuchin go out and say, "Oh, well, we don't mind a weak dollar. It's no big deal." It is a big deal, because it's especially a big deal when you're $1 trillion frickin' dollars in debt this year. They're running a $1 trillion deficit, which is insane. I know we lose track of how big these numbers are. $1 trillion is a lot of money. It's 1,000 billion. Like, you're all impressed when someone's a billionaire. This is 1,000 of those. So it's $1 trillion of additional debt. And here's the funny thing: the government just approved it, right? They just approved 2 years of this monstrosity. So basically, they're saying we can add 10% more debt to the GDP to our economy, another $2 trillion over the next 2 years. I don't even know if there's a limit. If Trump can keep it down that far, because they're assuming tax returns that might be unrealistic. Their model bakes in some astounding growth that I don't think is going to come. And without that growth, then the negative taxes are just negative, and there's no positive, and we're screwed. Anyway, so that being said, these are all good reasons why you don't want to buy U.S. bonds. We will see what happens. But meanwhile, again, the dollar seems like something that should be getting stronger, so we'll see what happens. What else? Oh, yes, gasoline. That's the other thing we wanted to look at, though. So, do we have support on gasoline at 175? We don't. Look at that. We don't really have good support. We have some support. See, it held up. It was a good line, and you would think at least it would be bouncy. And now here's where the 2.5%, the 2.5% rule comes into play. And no, there's no actual separate 2.5% rule. It's the 5% rule. But the 5% rule says things move in 5% increments, but I just called it the 5% rule because it's, you could call it the 1.25% rule, because the more liquid something is, the more you can break down the increments from 5%. So you can go 5%, 2.5%, 1.25%. Those are all the places you expect to see a pause because of the computer trading. And above 5, it actually jumps, though it still goes in 1.25 increments, but the significant levels above 5 are 10 and 20. 15 is not that significant, 7.5 not that significant. It will do something, but the major things, it's going to be 1.25, 2.5, 5, 10, and 20. That's the 5% rule, really. On each of those kind of moves, you expect to see a retrace. So here we go. 195 to 175 is the bigger move for the month. Not for the day, we're down 2.5%, so we expect to bounce today. But the bigger move is 195 times 0.8. What? That was wrong. 195 times 0.9, 1755. So the 10% drop from 195 is 1755. That is right where we are now. So we'll zoom in a little bit. And we're right there. So in theory, this should be bouncy. And that was from 195. So obviously 185 also. See 185, we had a little thingy there. 185 also. Now it's a 5% drop from 185. Not exactly, but roundabout. So basically it's a 5% drop from 185 to 175, and we did not have much of a pause in the drop from 195 all the way down. But you see how I did it? 180. See what happened here? Now let's see if we can make this bigger. 195 to 185. You see how it consolidated here a little bit, bounced back. That's a strong bounce. Failed the strong bounce. Then it's coming back, blows right through the floor, and keeps going to the next level. It's actually a great way to watch the 5% rule in action. So now we're at 175. You would expect at least a weak bounce here, and the weak bounce should be off a call it a 10-cent drop, right? So the weak bounce should be 2 cents. So we should get to 177. Now in gasoline, that's a lot of money. So I don't have a good reason not to take it. I mean, especially because we'll just set a hard stop below. So let's officially make that a trade. RB. You guys are jumping on it. That's not fair. All right, well, I'll take it at 176 because you're mean. Oh, good. I can't even fill it. You're all taking it. Fine. Fine, be that way. No, I'm not paying 176 plus. Yeah, screw it. All right, well, that's my recommendation anyway. You guys piss me off. And the thing about playing gasoline on a Wednesday is that you know the weekend's coming, and you know they like to jack the prices up into the weekend. And even if we had bad news today, which we did, we had a big build in gasoline. There was despite, I'll show you the report in a minute. There's a big build in gasoline that shows a significant lack of demand. So terrible news. That's why the thing went down 2.5%. But of course, you're going to bounce off 2.5%. That's like a law. And how much is it bounce off 2.5%? It's 20% of 2.5% is half a point. So we should bounce back to minus 2% during the day. So even if it's going to keep going down, the chance of it not bouncing off the 2.5% line is very, very slim. Well, here we go. All right, let's see if I can get one. Oh, come on. Guys, stop buying for a second. Let me get one. Be nice. I need to make money too. There you go. See? Never chase. Here's a good lesson. Never chase. They go up, they go down. If it goes up, then you don't buy it. There's no sense in overpaying for things. So that's 176. I really want to be at 175.5. So if we come back to 175 all the way down, it's far. 170. If we come back to 175.5 and I buy another one, my average will be 176 or less than that. That's okay. I don't mind that so much because we're expecting a 2-cent move up, and I'll catch most of it. So right now I just have the one contract at 176.2 because I didn't get a good price. I'm only buying one contract. I hope it goes lower. I frankly, even though I have a long now, I hope it goes lower before it goes longer because I want to have more than one contract. All right. Anyhow, All right, these lines are doing okay. NASDAQ's holding up. Dow's a little bit below, but they'll survive, and we'll see how the rest do. All right, any questions? How are we doing? No questions at all. You guys are amazing. Okay, maybe I'm amazing. Who knows? All right, we'll see. Oh, I know. The big thing I wanted to do is go over the watch list and see what there is to buy. Indexes. Let's take a look at that first. These are dailies. So look, in the big picture, first of all, how this is hardly even a dip. We're back to where we started the year. See, there's January 1st. There's January 1st. There's January 1st. Well, there's January 1st. The NASDAQ is still over. The Russell is no, wait, there's January 1st. The Russell's under. The NASDAQ's over. The Nikkei is well under. Europe is under. And Germany is under by 800 out of 13 is like half a point. It's more than half a point. I mean, not half a point. I'm sorry. It's more than 5%. 5% would be 6.5. So it's like 7%, something like that. So Germany's the worst. Germany's down like 7%. Other guys are, the Euro stocks are down. What is this? 350 from 5 is 150. That's 5%. So Euro stocks are down 5%. Nikkei 23, 2150. Oh, that should be easy. That's 1500, and out of 23 is 6-7%. Okay, so in that range. So so pullbacks. So so internationally they're down about 5%. We have that chart today, in fact, on the thing. See here. So internationally, people are not doing well. From January, especially. Here's January for the Euro stocks. And you can see how they got killed. And here's January for the Nikkei. Here's our January. We're just flattening out to it. Nikkei's way below. So that's where we are with those. We want to consolidate here. We don't want to go flying up, especially here's that 2700 line on the S&P where we started the year and where we consolidated on the way up. It would be very, very nice to do some more consolidation and then start a nice gradual ascent that takes us back to 2850. And then we stop there, consolidate. And meanwhile, this is already like into the end of the year. Then we stop there and consolidate and then head up next year. That would be nice. That would let the value, assuming the earnings continue to be good, that would let the values of the stocks start catching up with the index prices. And they need to do that. Otherwise, you will always have to be in fear of this kind of drop. Because right now, the price of stocks is so far ahead of the value that you just can't play it. I mean, we can play it, but I mean, you're just gambling every time you get in there. And look at the, speaking of gambling, look at the VIX. Holy cow. Somehow, see, it's funny because I don't know how it doesn't consider this volatile. We're up and down a few hundred points today. And the VIX is down 33%. VIX is down 33%. That's so funny. Okay, anyway. This is not, well, let's look at the hourly chart. Look, see, this is not volatile, according to the VIX. This is this is 24.5, 25,000. The 500-point move from the open above the, like 700 points, then down 300 points. That's not volatile. That's 33% less volatile than it was. It's a really broken indicator. Nobody has questions? Is anybody still there? Usually get some questions. Anyhow, all right. At least the home audience will hear it when we do the recording. Let's see. Oh, here we're gonna now. I'm gonna get into a whole thing about like stocks to buy and all that on the watch list. So let me know right now, or hold your peace for quite a while. So under the virtual portfolio tab, we have our watch list. Chris has a question. Thanks, Chris. It's good to know someone's alive out there. Is there a way to play the gas bounce using an ETF or specific equity? It's a good time to buy gold like Nugget. I'd buy gold like ABX. Gas. Okay, well, gas, the ETF for gas is UNG. And where is it? UNG. And here's the intraday. So the problem is, though, the ETF, it goes up from 22.72 to 23. It was a 25-cent move. So the thing is, yes, you can do it. We picked up. Where's the futures? Energy. There you go. So we get this move from 69 to 73. So we get a 4-cent move. On natural gas, that's $400 a contract. Okay, so we're getting a $400 per contract move here. To replicate that on the ETF, hang on, I got to put away the question box. Okay, so to replicate that on UNG, and you say, well, how am I going to get a $400 profit out of a quarter point move? Well, they have 50-cent increments here, but they were what, 23. So if you picked up the 22 calls for $1.15, right? They have a delta of 81, so they're going to go up 20 cents. If they're going to go up 20 cents if natural gas goes up. Oh, if it goes up $1, I'm sorry, if it goes up a quarter, it's 80. It moves 80 cents per dollar. So they're going to move 20 cents if natural gas goes up a quarter. So you'll get a 20% gain. But then you got to back that out and say, well, how would I make $400? Well, $400 is 20% of 2,000. So you have to buy $2,000 worth of the 22 calls, and then catch the move. The problem is, though, there's a fee of that, and also look at the bid-ask spread. It's 102 if you're trying to sell them, and 122 if you're trying to buy them. See, the thing about the futures, and the reason we like to play them short term, and we don't play options short term. I never call short term option moves at PSW. We have a guy op trader who does nothing but I personally don't like it. I think there's too much fees and too much churn, and it's just not worth the hassle to me. So I prefer to just pick that's how I ended up drifting into the futures, because I like short-term trading. It's fun, but the fees kill you. The fees and the spreads just totally destroy your profits. With the futures contracts, it's like $3 to buy and sell the contract, and you make your $400. So your $6 commission on a $400 profit. That's the way to play it. Or maybe it's $150. Things like $1.50, and it's $3 total to go in and out of a contract. So that's mindless. I mean, you're paying nothing. But in the options, if you're paying, if you're making 20 cents and you're paying even a nickel a contract, you're killing yourself. In and out a nickel, and you make 20 cents. You're basically playing for the broker. So that's the problem with trying to replicate these things with the a short-term move like that. It's just not worth it. And meanwhile, futures trading is not complicated. Look, all you do, where are we? Active trader. All you do is you open up a futures tab, you click on the thing you want to buy. Oh, way to go. Oh, it's getting lower. Now, my average is 1762, so as long as I'm under 1768, I'm going to average 176. So I'm going to watch this and see if I can catch the bottom. Anything below 17580 should... Stop. I want it to go down, not up. Anything below 1758 is going to average me down to 176 even, which is what I wanted. In a perfect world, I want 175, but that's not going to happen. Because remember, 1755 is the bounce line. So that's what I'm hoping we're going to retest it right now. So I'm down 200 on my original contract. That might be it. I mean, frankly, I'd be more patient, but I'm teaching a webinar, so I got to get back to work. You know, it's like otherwise I would have rather waited it out. Now you see here, this annoys me because I knew this was going to happen, and I just don't want to go in and out of it, but I really should. I'm just leaving it. It's kind of against my nature. It's like I really prefer to just take the profit and then get back in. But I am seriously worried about missing a big jump in the dollar. But on the other hand, I'm going to be seriously annoyed if we test here and come back here, and I could have squeezed another couple of $1,000 out of it, you know, by getting in and out. So betwixt and between, they call it. Oh, look, see, back to 58 already. It's good. Now, if I were playing this, you know, conservatively, I would then cash out here, and then I'd have one contract, but at the strike that's lower than I started with. Because the main reason you want to double down if you're going to do it is to improve your strike position. Once you improve your strike position and you can get out even, you should get back to the even and then relax. But I wanted 2 contracts at least to start, so I'm not really feeling it. So I don't know what the news is. That annoys me too. It could be a reason the dollar's falling apart, but I'm pretty sure it's a technical pullback. And for a technical pullback, we'd have to say it came from this line, 89.30. To basically 90.30, so that's a whole point, and that means unfortunately a pullback would be 0.2, so we'd be looking at right here 90.10. That's a weak retrace. Even if it's strong, it's still probably going to test 90.10, and if it goes below 90.10, then it's probably going to go all the way back to 90, and that's pretty annoying. Or maybe even this 89 line over here. You know, and that's money. I mean, we dropped $500 while I'm talking about it. So, you know, there's a definite school to saying you should get in and out whenever you hit resistance and then come back in. But sometimes you miss a big rally, you know, because it gets away from you. All right, so we talked about the gas. Good time to buy Nugget. The price of ABX right now, Barrick Gold, I wouldn't do anything else in the gold space. Although we did just buy NAK, but that was only because we already had it. Northern Dynasty NAK. Oh wow, back to 113. Okay, well I'm glad we did. We missed the double down at 85 because unfortunately I figured I'd wait a few days and see where it settled. It didn't settle. It bounced right back up. What happened to NAK is they own the rights to a massive, probably the world's biggest gold mine in Alaska, but it's surrounded by fishies, and you're not supposed to hurt the fish. So they're having a big fight with the EPA, and we thought that with Trump in, the EPA would give them a pass right away, but they didn't. They put them up for review, and so a lot of people got really disappointed. How disappointed? This disappointed. Went from here to here, 50% drop. So we bought our first batch here, and I didn't double down here. We just doubled down yesterday. So right here we doubled down at $1. So our average is 140 now, which isn't bad. I'm happy with 140 average. But actually it's lower than that because we haven't sold the calls yet. When we sell the calls, so they didn't hit 60 cents. When we sell the $1 calls for 60 cents, it's going to drop our average from $1 to 70 cents. So our average is going to be. Is that right? Yeah. If our average, oh no, I'm sorry, it's going to drop it from 140 to 110. I apologize. So our average is going to be here with the short calls at 110, and we're expecting it to be back in the 2s. I should talk about that too. Oh, all right, that's not that important. Anyway, so we think that this was just people who thought that there was going to be an easy pass from the EPA, like we did, and they didn't get it, so they bailed on the stock and dumped it. But it's just because you didn't get a pass, they are now going to submit their plan to protect the fishies, and And all they have to do, I'm fairly sure with this EPA, all you have to do is say, we're going to pray for them, and they'll probably give them a pass and let them start drilling. You know, I mean, they're trying to keep all the people in Alaska are mortified, especially the Indians and people like that who are up there. They are mortified, and the fishermen too. Of course, they're salmon fish. You know, so they're like, you guys are going to pollute one of the major salmon fisheries in the country. I think probably the biggest salmon fishery in the country, and basically Northern Dynasty is like, oh no, we won't. just like Exxon says we're not going to spill any oil, and BP says we're not going to spill any oil. They're like, oh no, our runoff will be contained. It won't get into the streams, or it won't go into the water. You know, you're talking about $1 billion industry in competition with what they hope to be $1 billion mine. But that industry is going now and has cash flow and lawyers and lobbyists and all that stuff. So they are fighting hard to stop them from doing this. But they've been fighting them for years, and it's a tough battle. It's tough. And what they've just got to do is come up with something bullshitty enough to make it seem like they're going to be able to protect the environment, and they'll get a permit to drill because the EPA will have no. And again, the EPA that doesn't really want to stop them anyway is going to say, well, we don't have a legal reason to stop you because your plan looks pretty darn good. You know, they're going to say, hey, yeah, we reviewed this, and your idea to like have a bunch of bounty towels around the site to soak up any of the mess is going to be a good idea. You know, whatever they decide to do, that's how it's going to go through. So my attitude, which may be wrong, but my attitude is I believe that they're going to get this thing done. And obviously, a lot of people bailed and thought they wouldn't, but then a lot of people came in and started buying also because at this price, why not? And you know, we missed the bottom. I would have absolutely, once it fell 50%, I would have absolutely done it. I missed it. It was my fault. So we missed out on a 20-cent better price. But anyway, so there's a gold miner I like, but this is speculative because you're not really betting on a miner. They have no operation. They have the rights to start an operation in Alaska to start strip mining and destroying the environment and all that. They have the right to do that, but they've got to get the permission from the EPA, and the EPA has to get past all the environmental activists who are freaking out that this is the worst idea in the history of mankind. So it'll be interesting. But I didn't come to talk to you about Northern Dynasty. I came to talk to you about Barrick Gold, ABX. Now, Barrick Gold is a working miner who has 100 million ounces of gold. You want to invest in gold, they've got 100 million ounces of it. So my attitude is, why invest in gold? Well, not why invest in gold. If I'm going to invest in gold, why don't I invest in a guy who's got 100 million ounces of it sitting in the ground, and they can get it out whenever they feel like it? Not only that, though, but Barrick Gold is a very low-cost gold producer. They have the lowest-cost gold producers, so they can pull it out of the ground for under $800 an ounce. So they're clearing a lot of money on the extractions. They're super out of favor right now. So is the whole gold industry, though. Everybody's trading down. Let's see what Gold Corp. Gold Corp's another good one. GG. You know, even like look at Gold Corp's gotten traded off. Well, it's crazy. Everyone's bailing on the miners, which I don't get it. so while they're doing it, sure, there's a lot of nice looking cheap miners. You know, and it's not like gold is even coming down. I mean, people are just for whatever reason, everybody's bailing on the mining space. So I think they're nuts because, first of all, they're going to report Q4, right? Let's see. Barrick reports ABX. Now, I know why Barrick's particularly. They just paid $429 million in Peru to, they just took a hit on their Peruvian stuff. I'm sorry, they didn't pay it. They're taking an impairment. So they're actually, cutting their taxes, but they're taking an impairment of $429. They're reclassifying their reserves because the deal they made with Peru probably cuts down the amount of gold they're going to be able to access by $429 million, which is a lot, but what are you gonna do? It's like 500,000 ounces or 300,000 ounces of gold. and again, they've got 100 million ounces of gold. This isn't going to really affect the company much. They're just going to mine it elsewhere. PE ratio is 7. And let me show you what that looks like, okay? They're valued at $15 billion, okay? In 2016, they made $1 billion. And this year, oh, you can't see the quarterlies. Oh, sorry. Oh, well, anyway, so they're doing well. Now, let's keep that in mind, though. Last year, here's the current quarter, December. Oh, when do they report? I don't know. Anyway. So the quarter that is estimated is this December. Last year, 2.3 billion in sales. This year, they should have about the same sales, which I question, actually. I think that's probably underestimating it. They're probably going to earn about 70 cents, 75 cents a share. Last year, this year and next year, they should earn about the same. All right, and it's only a $13 share. So the PE really is probably around 15 if you look at it. So it's probably about 15. But here's the thing I look at for a gold company. Last year, in Q4, which is October, November, December, so starting in October and going to December, they averaged about here, which is $1,200 per ounce of gold. This year, from October to December, they averaged more like $1,280. So they collected $80 an ounce more than they collected last year. And let's assume the mining costs were flat. If the mining costs were flat, last year they made $400 an ounce. This year they're making $480 an ounce. They're making 20% more money per ounce for the same gold. And Q1 obviously is looking better than Q4 did. So why would the stock, wait, this is gold, right? Yeah. So there's what gold was last year, and then so why is the stock? So you see the logic. Just look at the price of gold and say, well, they're selling the gold for more money. So why is the stock compared to last year coming down? Because here's where they reported last year, and they reported earnings. Let's say here, and they shot up. In fact, they went flying higher on the earnings report. And now they're trading $7 lower, like 30% lower than last year. And as far as we can tell, they're going to earn 20% more money. All right, so I like it. I think this is a great leverage way to play gold. You're buying a miner. They own all this gold. They'll take it out of the ground over time. So it's like you're buying a guy who has a huge vault full of gold, and he's going to sell it over the next 20 years, instead of just buying gold right now and crossing your fingers. These guys run a business, and that's the thing. Even in a fallback situation, they run a business that generally makes money. Whereas gold, if it goes down in value, it just goes down in value. There's nothing to fall back on. Here, you just sit back and say, wait for the business to come back. No biggie. So I definitely like these guys. Can you go over the and another problem with buying gold right now? I have that strong dollar premise, so gold should probably get some pressure and go lower. Can you go over the DIA hedge adjustment, specifically what to do with the short 257 puts? We did nothing with the 257 puts. DIA hedge. Where was that? Yesterday, right? Hang on. What now? Wednesday, global. Here we are. Yeah, futures trading is really easy. Don't worry about it. Control F. DIA. Not there. Okay. In the short-term portfolio, well, it's changed by now. Yeah, okay, so you can't see it. What can I do? All right, let me just try to explain it. We had, oh, well, it says here, we had the June 280, 260 bear put spread. So yesterday, the Dow got really low. Here we are. Indices. Dow. Okay, good. Hours. And bigger. There we go. So yesterday, the Dow got super duper low. It hit our target. And I said, well, you know what? We have the, you know what, let me go to DIA, I'm sorry. It'd be easier for you to look at the actual numbers instead of trying to extrapolate. Otherwise, there's too many wheels turning at once and your heads will explode. Okay. So we had the 280? Yeah, that was a cool play. Wow, that was smart. Damn, that guy's good. That was a fantastic hedge. Yeah, we had the June 280, 260 bear put spread because at the time, DIA was way up here when we took it. And I said, look, the only way this spread doesn't make money, 280, 260, is if the Dow stops going up. I said in any situation in which the Dow stops going up, we're going to make money. Because we have the 280s already, so we would make money. I think it was like basically we make a double off what we put into it. So let's say we bought it for 10 and it was 20. So we did that. So I said, if there's no situation in which we go down that we don't get a double and make whatever it was, $20,000 or whatever. And the only way we lose is if the Dow goes from 260 to 280, which is where's 250? That's this much of a move. And that much of a move in the long-term portfolio, we already knew was going to pay us like $50,000. So since I know I'm going to make $50,000 and I'm only going to lose, it wasn't even 20,000, I'm only going to lose X on the, like 5,000 on the trade, then it's a great hedge, right? So that was the point of the hedge. Now, we got this gigantic drop all the way down to here to 240. So our 280 puts are now worth $40. We still have the 260 puts, but I think we're going to bounce. So we sold the 280 puts. We rolled the 260 puts, which were June, but they were so in the money that they really had no premium left. So and also the 257 puts from February were so in the money they had no premium left. So we rolled the 260 puts to the 257 puts for very little money, for $3, $4, whatever it was. So we rolled the 260 puts to the 257 puts in February. So now we have 40. We had 20. So we had 20 of these. We had 20 short February 257s. And we had the 20 short 260 puts in June. So we cashed the 280s, boom, done, collected all that money. We waited, we didn't even wait for the bounce because we were so pretty much sure that it was going to happen. So we just rolled the puts along. So now everything expires for this guy in February. So now we have 40 257 puts, and we have no spread at all because we rolled the old spread. So now we covered though with a, I think we covered with a much cheaper spread, which was the 250 230 spread. So now we covered with a 250 230 spread at $7. So in other words, we took $72,000 off the table, and we then spent $28,000 of it to cover the remaining short puts. Now, what's our premise? Our premise is that Dow will recover to about 257. We will probably not have to pay anything back to the short caller that we have here, and meanwhile, our spread will maintain most of its value. Meanwhile, it's still a good hedge. If the Dow doesn't go too much higher, it's a good hedge, and if the Dow does go higher, we can adjust the hedge to put a little bit more money in. But meanwhile, we're going to cash out. Now, right now in the short-term portfolio, We have the 40 because we rolled the old ones in. We have the 40 short February 257s. We sold them for an average of 858, and they were already down to 685. But the net cost of these things is like, it's like 30,000. Oh well, here it is. It's $34,000 worth of these things. If they expire worthless, we're picking up $34,000 less whatever we lose on this spread that we spent $23,000 on. So in other words, what we did is we basically went longer. Originally, the 257s, where's DIA? Originally, the 257 short February puts were to cover us because if the Dow kept going up and up and up, we wanted to offset some of the cost of our spread with these which would expire worthless. Obviously, anything but a pullback and these expire worthless. Now, if we have a pullback, which we did, what we know, and this is the hard thing though, this is where it gets to be like a chess game. You have to think moves ahead. We know from doing this a million times that the 257 puts can be rolled. So if we look at the February 257s, which are showing $7 now. Oh yeah, because the Dow pulled back. They're showing $7 now. All we have to do is go down line. Let's look at April and see which puts are $7. And in April, the 250s are $7. So we know that we can roll to the April 250s, and then from the April 250s, we just got to look at the next thing that's $7. So let's look at June. And what's $7 in June? The 245s, but really they're a little bit more than $7. So basically, we know we're good all the way to 240. So now we go back to DIA and say, how far did we fall? We fell to 240, but that's where we would keep rolling and put our short puts lower if we felt the need. Although now it's a moot point because we caught up. But even at that point, though, since we just bought the spread for $28,000, and this spread, the 250, 230, 40 of them, this spread pays, wait a minute, 40, 80. This spread pays $80,000, and we only spent, right? It says 20 times 40, right? So this spread pays $80,000, and we only paid $23,000 for it. So it pays us $60,000 more. So that means that we're covered for another $60,000 below, $15 per contract below 240. So really, between now and June, without making any other adjustments, we're good all the way down to 225. 225 is a 200-day moving average. So you just got to think ahead about what's going to happen, what could happen, so on and so forth. Now, at this point, since we're back to better than even on the short 257s, what we would do is if this fails and we think the market and we start losing faith that the market's going to go. Now, right now, this isn't a failure. We're just consolidating below the 50-day moving average. There's nothing. This is natural. And my projection for the market is that we do keep consolidating here. I'm thinking we probably will have to roll those 257s. I don't think we're going to make it back there. I'm not saying we will, but that's the puts that we have right now. I just didn't want to adjust them further. It was just to be simple. I rolled everything to the 257 puts. But next month, we'll roll it down to the 250s, which is the 50-day moving average, and then we'll roll it to the 245s. And then hopefully one of those times we'll get a little bit of a positive move in the Dow, and we'll clear it. But meanwhile, if we think this is starting to get weak, we're going to buy back half of those short calls. Now, it's not going to affect our portfolio because our portfolio is sitting on $400,000 in cash at the moment. So we got plenty of cash to buy these things back. They only cost $27,000 to buy them all back right now. So should these guys, which are $6.85, come back to like $8, we're going to buy back half of them because then we have better control for our rolls down the road. And you'll probably have to play it back like 5 times to get it, but it's like chess. I mean, it's, it's like you can ask, can you explain what you just did in that move, in that series of moves? It's like you kind of have to start playing the game to really get a hang of what it is. But there's a move and a counter move, and then if this happens, we're going to do this, and if that happens, we're going to do that. But the bottom line is, and the key to the whole thing, the reason the short-term portfolio was up 500%, even in an up market, is exactly what just happened. Because we know how to use the 5% rule. When we got a good move down, anytime that we got, and they were few and far between in this market, but when we get a good move down like that, we make spectacular money because we cash out the short put, we cash out our long put, we leave the short puts, and then we cash those in on the bounce. So we make much, much more money from the spread, from the hedge, than you would plan to make on the hedge, because we break it up and then we adjust it. That's one of the features of doing it that way. But you've got to you have to understand your rules. You have to be on top of what's going on. You have to understand, why is the market selling off and why is it going to stop selling off, and don't be wrong. And also, you have to not mess around with SVXY, because as great as our gains were on this DIA, we wiped them out with the stupid these stupid SVXY things that lost $65,000. Because of those, we're down 2% in the portfolio. We would have been up $65,000 from the DIAs. I'm really pissed, but what can you do? It's a total screw up. I mean, this thing, we did not think for a second this was going to happen. These went from 130 to 12. So we sold them. It was the same logic as the DIA, except unlike the DIA, which dropped a reasonable amount of money, this thing dropped to nothing, as if it was wiped out. So we're trying to salvage what we can, but this unfortunately destroyed our gains. But let that not take away from what a great way to trade this, what a great play the DIA play is. It just, unfortunately, with SVXY, and now we learned a lesson, you can't do it with this kind of instrument. Because I mean, not that anyone ever thought that was going to happen, but it did. It dropped like a rock, and it went to zero, and that screwed up the whole plan. Hopefully the Dow won't go to zero. So the Dow is highly unlikely to go to zero. Therefore, this thing works. Even if this thing had only gone to 60, we would have been able to save it. But at 12, you can't save it. There's nothing to save. It's dead. So we just got totally screwed there. This is down 163, but that's because we cashed the longs. So that's why there's so much cash here. But we have to at some point reconcile and buy those back. But on the whole, okay. So we blew it. We blew the gains that we would have had in our hedges. And we're even, but fortunately the long-term portfolio is even too. So we just basically lost a month of time. Where's the long-term portfolio? Long-term portfolio is down 2.2%. So on the whole, we're down about 2% overall. And unfortunately, that sucks though, because we would have been up 10% from the short-term portfolio, except we blew it on that one on the SVXYs. So if we never do that again, we should be in good shape. All right. Q4 earnings will announce. I assume that's on Barrick Gold, February 14th. That's great. Valentine's Day. I can remember that. ABX. All the gold bugs have switched to investing in wheat stocks and crypto. Okay, I buy that explanation. Also, ABX just today took a 500 million short. Right, we said that. Yeah. I mean, the charge for the mine, I don't have a problem with that. That's just an asset impairment, because they booked it as a, they bought this mine and they booked it as a $2 billion asset because that's what they expect to get out of the mine over time. Now, because they had to make an agreement with Peru not to do so much money, not to do so much strip mining, whatever, they're like, well, we're never going to get to $400 million worth of that gold. Therefore, we're going to take it off the asset. They're doing it now because by doing it now, this year, they're in the higher tax year, and they're going to take the deduction now while they can, because next year they only have to pay 25% taxes. So they don't want to take an adjustment next year when it barely affects it. So that's their logic. So all they're doing is doing good accounting, and they're getting persecuted for it. I find it very unfair. But you know, again, the problem is you got to realize, like, if you're an investor, you have to realize that you're really investing against traders. And ooh, natural gas, gasoline, 175.5. Oh, see, we're right back at where I wanted to. We're right at the entry I wanted, 1755. So now I am going to. I'm not well. Let's see. What happens if I add now? I'm at 17597. If I add at 1755. I get down to 1775. I like that. I'm going to do that. I really think this is going to hold. So I'm going to add. There you go. I've just made a futures trade. See how easy that is? Where the hell is the line? Oh, there it is. So basically in the futures. Oh, and by the way, you know, you can actually do this with options. I got to show you this. Where am I going? Okay, all products, right? DI. Okay. So let's say that you want to trade those DIA 257s. Here they are, right? I'm going to right click here and I'm going to say copy that. Okay? Now watch, I copy that and I go back to Active Trader and I put it in. I'm going to now delete that and I'm going to paste it, just Control V, nothing special, and hit it. And look what happens. It's just like the futures trading. The default is 10 contracts here. It's just like the futures trading. You got to be careful of the default, and you can adjust that by opening up this one. I call it business. I don't know what it's called. Big buttons. Well, you see that where it sets your quantities and stuff? It says BTNS. So if you open that up, you can change your sizings. Meanwhile, you see what this is, though? Now you can actually see the live bid ask and the lot sizes of the bids and the ask around your strike. And you should learn how to do this with your options. If you're not, I don't do it because I've done it for so many years that, like, when I look at an option, I know what I get it. I can see from the way it's moving. I can see. I get it in my head. I know where the bid and ask is, so I know where to place my offer. But if you are new at this, it's so great because you can actually see exactly what the spread looks like. There's 300 guys offering to 500 guys offering to buy. There's 150 guys offering to sell. They're pretty far apart on price, but if you come in here, you've got a very good chance of filling. So you want to play the middle, and you want to find a spot in the middle they're willing to go. And the nice thing is that you can move your button around and adjust it. And you can do that with any option. And you can see exactly where it's trading and exactly how much the bid and ask is. This is the last price it was sold at. The last actual transaction went off at 8:30. And right now there's a guy offering there, and there's guys offering to buy here. And if you see a lot more people trying to buy than trying to sell, probably there's upward pressure. And you can see that from the fact that the elevator, which I don't know, whatever you call it, I call it the elevator, but the elevator is in the middle. Is in the upper end. Because the pressure is up because more people are trying to buy than trying to sell. They're holding out for their price. Also, you want to watch the size. If this, see the size diminishing, it's going to go up now. Watch. There it disappeared. And now they're going to have to find the next level of sellers, and it's probably going to be higher. So we'll see what fills. Up, see how he ticked up? All of a sudden there's offers at 775. Oh, and look where the next buyer is. Holy crap. Next buyer is way up there. But see, I could tell that was going to happen, and you'll get used to this really fast. I could tell it was going to happen because there were a lot of guys here, less and less guys here. All of a sudden, the last guy here disappeared, and nobody's making an offer. And now you see this thing creeping up. So you can gain total control over the bid-ask process by doing this stuff. So it's definitely something you want to learn. And even if you don't have Thinkorswim, you can still open up a paper trading account. You can go to Thinkorswim, download the application. It's TD Ameritrade that runs it. And you can paper trade stuff. And I really think that practicing on the system is the way to go, because it gives you such an insight into what goes on in the market. See that? See what happened? Keeps creeping up now. Now they filled. Now you're way up here if you want to try to fill an order. And what are these? These are DIA puts that are going up in price. So that means the Dow must be going down. And there it is. In fact, you can see the Dow going down. So I can tell from this that the Dow is going down because the pressure of the put price is going up. So that's good. It's all connected. Oh, And, oh, I didn't buy 2. Oh, I'm such an idiot. If I had bought 2, I would have just hit my break-even point. I could have gone back to 2 contracts. Ugh! What was I thinking? I get so sidetracked. I meant to buy 2 so I would average out at 175. I mean, at 175, sorry, 175, 175.75. I'm 175.81. Had I bought 2 contracts back then, I would have averaged out at 75, and we could have just cashed back to 2, which is the whole point. I really want 2 long contracts at 1.755. I couldn't get that, so I started higher. Now it went back to where I wanted it. I added 1 and brought the price down, but if I had added 2, I would have had the right price. All right, well, that's okay. We'll get there. And I'm not worried. By the way, I can be lackadaisical about this because I really believe strongly that by Friday we'll be back around 180. And by the way, 180 is going to be more than $1,000. Sorry, it's $2,000 per contract gain. So that's what I'm projecting on this. So it's $420 per penny on gasoline contracts. Now, if I'm wrong, you lose $420 per penny. So keep that in mind. But anyway, so I can just, even if I'm not watching, I can still put my sell offer here. That's my break-even spot. So now I've logged a sell, and you see I got 1 sell. If I want to cancel it, I do that. If I want to move it, I can just drag this thing up and down, or I can drag this thing up and down. But now I'll automatically go back to 2 when it crosses this spot. So when if it does go up, it'll bring me back down to 2 contracts at 1.758, and that's good. Then I'm in a pretty good spot. All right, but this is very valuable. I forget to emphasize that, how great that is. Whoop, it filled. Okay, so meanwhile that filled. So now I have 2 contracts at 1.756, which is basically where I wanted. Remember I said 1.755 was where we projected from the 5% rule. That's where it said the bottom was going to be. Now, obviously, it's not set in stone because it's just, first of all, I made up the 5% rule. Let's keep this in mind. I made the whole thing up, so it's just as bullshit as any TA. The only thing is I did it based on really paying attention to computers and how they trade. So mine is based on how robots trade, and it's based on the very cynical assumption that 90% of the market is traded by bots. Turns out it is, because it works better than almost any other TA. All right. Anyway, so now we're in good shape. So everything's going good now. So what's oil doing? Is oil bouncing too? Yeah. So okay, so oil kind of held 61.50. And what's that on Brent? So I'm curious how that looks on Brent. BZ, probably 65. Yeah, 65. See, 65 on Brent. The Saudis are not going to let that go. So there you go. That was a great floor. So even though it doesn't deserve it, there's nothing in the report that says, oh yeah, we're going to look at the report. There's nothing in the report that said that they should pull out a thing. You had a couple of reasons for it to happen. You had the 2.5% rule that we felt that we'd get back to that price. And you've got the Saudis supporting oil because of the Aramco deal. And also just knowing that oil, I mean, again, that's back to the 5% rule. Or, oil doesn't move. Big things don't move more than 2.5% in a day. It's very rare. I know the market just did that, but 2.5% is a very, very big move for the market. Uh-oh, suddenly these questions. What's this? How confusing. What is the easiest way to buy green coins, and do you need a digital wallet? Also, is it a good time to buy a 3rd position now? Okay, lots of questions there. Green coins. There is a primer somewhere on PhilStockWorld, I don't know where, about buying green coins. I don't know. Green coins. PhilStockWorld.com / green coin. December. Wait a minute. Oh, here you go. Aha, so it's in my Twitter feed. So, can you copy that? Let me see if I can copy that and paste it for you. Control-C. What if I put it here? Is this an answer replace? Control-V. Enter. Nope, that didn't work. Oh, send to all. Okay, let's see if that did something. Did that work? I don't know. Anyway, if so, Bitcoin, cryptocurrency. This is when we said we'd accept green coins for payment of membership. That's over right now, but we might do it again in April. Where's the thing from Chris? I'm sorry, I thought I had a link here. No. Have they made any progress on the green coin site? Anyway, okay, so we can always Google green coin, GRE, and you get to this thing, not that, coin exchange. Whoa, what a mess. And there's how it's trading right now, which is not good. It's down quite a bit. That's not the one I usually look at. Green coin, GRE. It's not coin exchange. But anyway, yes, you have to open up a wallet, and I honestly don't know how to do it exactly. Here it is. Oh, coin market cap. Is that the right one? Doesn't sound right. Oh yeah, this is the right one. Haha. So coinmarketcap.com currency/greencoin, and from them you can follow. See source code, website, Explorer. You can follow links to get to it, and so on and so forth. It's now back to where we were, to basically the price that we were buying it at back in December, and it's spiked up tremendously since then. It went all the way up from here to here, which is or about 20 times where it was. And of course, when it hit this, I told everybody. Actually, when it hit here, when it was it was just in around 75, 80, I said you got to sell. So it's my fault that it went back down. And I told people, I mean, if you don't take profits, you're just being an idiot. You know, when you get 10 times your money, you got to sell 1/10 so you're even. I would sell 2/10, and that way you doubled your money and you still have the coins, which is why we have our coins in the first place. The reason we have 150 million of these things is because we bought 2 Bitcoins worth of green coins back when green coin. We bought Bitcoins for $600. We bought 4 Bitcoins for $600. We used 2 Bitcoins to buy green coins with. The Bitcoins that were left split in 2, and we got green coin cash plus green coin. Those we ended up cashing when it hit $20,000. We cashed out of those, which was good because now they're like $7,000. We cashed out of them into 20. We still have the 150 million green coins that we bought when they were like, 0, 0, 0, 0, a whole bunch of zeros before it. So we bought a whole bunch of them. In fact, we own 10% of the entire market cap of this thing practically. No, I'm sorry, we own 5%. We own 5% of all the green coins. So whatever this is times 5% is what we have, which is like $40,000 right now worth of green coins. But at some point, that was $1 million worth of green coins, just to, when it spikes up here. But it doesn't mean anything because we couldn't possibly sell them. There's not a market enough to liquidate that many. And you can see, in fact, it tells you the volume. See the volume? 5,500. Most of these volumes are not very high. So you can't sell $1 million worth. A big day, 71,000 is a very big day for these guys. But still, you have to look at it. It traded at 0.18, and now it's at another 0. So it was 0.18, and now it's 4. It's 4. So it's now 1/4 of where it traded $72,000 worth. So there's active buyers willing to pay that. So you have a very good chance of making a double from this level. So I definitely like it. But you have to, the way it works, you have to set up a wallet. You have to get green coin first. Then you have to trade your green coin for, I'm sorry, you get to get Bitcoin first, then you have to trade your Bitcoin for green coin. That's the way it works. That's how most of the minor currencies work that way. You have to first get a Bitcoin, then trade the Bitcoin for the minor currencies. Sometimes you can get, now you can get Ethereum or Ripple, and those trade for other currencies too. But as far as I know, I've never transacted a green coin in anything but Bitcoins. So, and plus, this is how I can chart it, so I know what I'm doing. So, but it's a, you know, you don't forget, don't sit on those Bitcoins too long. You never know what they'll be worth 5 minutes later. All right. What strike for FNSR are you picking for the 2020s? 13, I didn't get into the debit call spread looking for, well, FNSR, let's see. Okay, let me get out of this. So the question, all right, so blah, blah, blah. So if you ever need it, it's on our Twitter feed. So if you go to Phil Davis, it's at PhilStockWorld, and then you can always go check my tweets, and then you can find all kinds of interesting stuff down here. I don't know what that means. This is Jackie's account, that's why, so I don't know what's going on. The question was FNSR, so we go to the options opportunity portfolio, I guess. And that's down 1.4% right now. So even with the hedging, we're down a little bit, but it's not so bad, it's fine. What strike price for FNSR? Okay, so FNSR, we ended up at, we have the 1320 bull call spread, which was 774.50, so net 280. No, wait, sorry, no, net 320, sorry, 320. So the net here is 320, and it currently is still the same price. So that is the price. So it's net 320 for the third. So we're in the 2020 bull call spread. We have twice as many of those, and we sold half as many of the 17 puts. And FNSR is currently at 17. So basically, with FNSR, we're calling a floor here. We're comfortable with a floor at 17. So we're willing to buy the stock if it's below 17. We sold those puts, and meanwhile, our target is what? I don't know. I can't remember. Our target is 20, which isn't a very ambitious target for 2 years from now. But we basically have the 1320 spread. But think about it. We have the $7 spread for 320. So we're going to make more than 100%, and all they have to do is get to 20. And it's more than that, though, because the net price of the trade is 15 minus 9 is 64, minus 3,000 is 33. So it's about $3,300 for the spread, and it's a $7 times 20. It's a $14,000 spread. So we can make $11,000 on $3,300, which is what, more than 3 times. It's 3.5 times 300. So we can make a 350% profit on the spread as it stands now. It's actually cheaper than that now because they put some more money. So you make a 350% return on this spread. You're risking owning FNSR at 17, and if it goes to 20, you're going to cash out $14,000 back on your money. So I really like that one. So you have 2020 what? You have a 2020 $23 put. I wouldn't really worry too much about it because if you look at the put, first of all, being assigned is not a big deal. It just means that what they're going to do if they assign it is they're forcing you to buy the stock. So they're going to give you the stock and they're going to take the money out of your account. That's what an assignment is. You promised that you would buy the stock for $23. So anytime this guy wants, it can't be 23. My 2020 23 FN, well, okay, I can't be 23. It's got to be 22. There's a 23 here in 2019. I'm sorry, in 2019, they've got 23s, but not 2020s. Anywho, so going by the one they have, the $22 puts are like $7. So what's 22 minus 7 is 15. So there's a lot of premium. You know, FNSR is $17.75, so there's $2.70 worth of premium in this put. So if the guy assigns you the stock, they're going to cancel the $7 put because he assigned it. He has to cancel. That's, you know, he's exercising the contract, not canceling, exercising the contract. So that money goes away. You keep the money, the $7, well, or less than $7 that you took. You then would have to. He would then put the stock to you in your portfolio, and your broker will extract $22 a share for it. But you wake up the next morning, you've got the stock, and you can turn around and sell it for $17. So the guy did you a favor. He didn't hurt you. He took away he wiped out $270 premium by assigning it to you. I'd be begging the guy to assign it to me. I'm like, please, would somebody be stupid enough to assign me this stock? You know, don't be in fear of that. All you do is turn around and sell it. It's no big deal. Usually broker gives you like 3 days to clear it up. Now, sometimes it works, yeah, and yes, sometimes it goes in your favor because the market goes up the next day. Sometimes it goes against you. It's never a bad thing, though. Now, if you have the 22 puts, they're $7. Let's say you have 6 of them. All right. The 17 puts are $4. So you could roll the 6. Well, wait, 6 times 7 is 42. And so you could roll it down to like 10. You can roll your 6 23 puts to 10 17 puts. And it really doesn't change the amount of the obligation very much, but it lets you have a much lower strike. If it makes you happier, but I don't see anything wrong with the target. I think FNSR could very easily get to 23, and there's tons of premium left, so I don't think there's any emergency to do it. It's like, why should I pay this guy $2.70 in premium so he doesn't do me a favor and assign me? It doesn't make any sense. Same question with Apple. Boy, May, you have a lot of stocks. It can go further down. I want to roll again. There's no way. 145 Apple. Really, you're scared of being assigned Apple at 145? If you don't want to have a short 145 put in Apple, you shouldn't be in Apple. You don't want to own Apple for 145? You shouldn't be in the stock. Why are you even messing around with it? You must hate that company. It's still one of the greatest bargains on the entire market. Yeah, the put went in the money, and the Apple went down, and the put is more than it is. Maybe it's down 50%. Maybe it's down 100%. It doesn't matter as long as Apple isn't below 145. It's never going to be assigned to you. If Apple holds 145, whatever the interim price is on paper, whatever your paper loss is, it's all going to go away when the premium expires. You have to get used to that, though. There's an ebb and flow to these options, and especially because on the big dip that we just had, the VIX went up, the volatility went up, and that multiplies all the short sales that you did. It increased their prices. That's why our portfolios, they look really bad right now, but that's because we sell a lot of premium. The VIX doubled, so all the premium we sold doubled against us. So our portfolio is counting it as some big losses, but that'll come back real quickly once it goes. And meanwhile, we made some really good adjustments that are going to help that also. And what are our adjustments, by the way? We sell more premium. When we make our adjustments, we sell more premium, especially when the premium's this high. How's the market doing? Oh, the Dow's up 140 points again. I love it. This is such a funny market. This can look like 215 and 216 to go through distribution over a couple of years. Yeah, but I'm honestly so not worried about it. I don't see the markets going down much. I certainly don't see good stocks like that going down much. And that's what hedges are for. What's your quick take on levels of the indexes? Oh God, I wrote that up in the thing today. I really don't want to get back into that. I'm trying to get to the next thing we're doing. Now you guys are asking too many questions. Hanson says yes. Oh, that's great. Yes. Why did he say yes? Because he was talking about green coin. Okay. Okay. What do you expect from ABX earnings? I expect, we just went over that. I expect them to be better than last year because they sold basically the same amount of gold, but at a higher price. I don't see how that wouldn't have happened. It's in the distribution pattern now, Apple, and I'm a little worried about a repeat of 2015, 2016. Okay, May, you made a commitment to buy Apple for 145. I assume you have 2020 145 puts. So AAPL. So you've got the 145 puts. They are now $14. That nets you into Apple for $130. It's at $160 now, so it's 20% below the current price as your net entry. It doesn't matter if they say 13 or 3 or 33, you're still netting in for 130. That's the way it is. Well, I don't know what you sold them for. Maybe you sold them for 6, but whatever. Was it the 130? Wait, 145s or 140s? It was the 145s, right? Okay. So, thing number one. Let's say it's a year from now, and you've got the 145 puts. Well, then your puts would be worth what these 145 puts are worth. A year from, nope, sorry, wrong ones. January. So a year from now, the 145 puts, assuming Apple is still at 160, assuming it's flatlining, the 145 puts will drop to $8. Still actually a lot of money. But then you will say, what can I roll these down to in 2021? So you're going to look a year ahead, and you're going to say, what's $8 a year from now? And it's a 130. So a year from now, excuse me, you should be able, as the premium begins to expire, you should be able to roll these things down $10 at no cost to you whatsoever without changing anything. Now, if you want to go lower, you can look for something that's $4 like the 110s, and you can roll to 2 times the 110s. And now we're getting to the realm of the absurd. It's because if you don't want to buy Apple for 110, if you're not willing to accept an assignment of Apple at 110 after you roll it and double down because Apple is doing badly, then get out now. Take the loss, get out, because you don't really want the stock. And if you don't really want the stock, you have no business selling short puts. You sell a short put in a stock you absolutely want to buy at the strike. And if you don't, then you're messing around with forces that you shouldn't be. And you get into the situation you're in now where you're worried about buying a stock, about getting Apple 20% below the current price. You actually are trying to avoid getting Apple for $130. Whereas I will sell my house to get Apple at $130. I will go out and get a second mortgage and buy as much as they want to sell me for that price. All right. Blah, blah, blah. Okay, good. Now, let us try to finish it. We've got about a half hour left. I want to get to, well, how's the market looking? Let's see. All good. All good. Oh, yes, look at gasoline. Ha, ha, ha. I love it when a plan comes together. Let's see. What are we making? Ah, $1,000. Who loves you guys? Come on. And like I said, that's nothing. I think we can do way better. All right. A responsible person would take $1,000, but would take 500 off the table because, I mean, come on. We just made $1,000 in an hour. Not even an hour. So good. So you see, so now, I mean, we went over it quickly, but now go back and look at the logic of the trade. Look at what I said. Understand what we're talking about with the 5% rule. Ask questions next week. But go back and look at, that's why we tape these things. Go back and look at it again and say, why did we go into the trade? What was our premise? How did we work our way into a cheaper price? And how does it go? That's all. Now, right now, we're back on this immediate drop from 182 to 175. Well, let's call it 182 to 175. 7-cent drop, so 1.5 cents above that, which is 177. You're going to hit resistance. That's a weak bounce. Okay, and after 177, 1785 is our goal. That's a strong bounce. But in between that is this line. So at some point, you might want to be inclined to take some of that off the table. But I think we'll do better. And again, it's the weekend. Oh, also, by the way, the bad news is past, right? There's not going to be more bad news. The bad news has happened. We had the report on the oil. There's nothing worse that they're going to do to these guys today. Bad gasoline news doesn't come out in the middle of the week generally. So it's really just the report. The report showed that there wasn't much demand. People freaked out, blah, blah, blah. But now it's going to come back to a medium price, probably in the middle somewhere. And that's a perfect spot right about there. And so I can make another $1,000. I'll be very happy. All right. I love it when a plan comes together, right, guys? See, these webinars are worth watching. Not wasting your time. All right. Where are we? Right, so we go to the virtual portfolios, and right here, the watch list. And basically, I can't get my elevator because this thing's in the way. Oh, come on. Oh, really? I can't move it around? All right. Oh, I can do the mousey thing. All right. So we talked about Apple. Wait. I did a big speech on GE. I still like GE. Hopefully there's a chart for that somewhere. With Apple, now notice we didn't make a play on Apple because I thought it was going to come back. I thought it was going to pull back. It pains me when we don't own Apple, but at 172.26, I'd rather wait for a pullback. I said that on 1.3. Here's 1.3. It went higher. And now it pulled back. Now's when you buy. And then we did. In fact, the hedge fund just bought it. We went long right here on this line. Very proud. We picked up 20 contracts, so that's good. We did, and we held off on selling the short calls, because that's how we enter a trade. We bought 20 longs, and if it got lower, we would have sold 20 shorts and rolled ourselves lower. And then we would have sold the puts. We still didn't even sell the puts. Because you don't have to. If you have a good entry, I don't need to sell the puts. If I enter these things for, I'm making up numbers. If I get into these for $30 and then I sell these for $20, I'm in the spread. I'm in a $25 spread for $10 for $10. So I don't really need to sell puts. I'm already going to make 200%. Selling puts is gravy. I sell puts when I get a pullback. Then I sell some puts. All right. Here's ABX. We talked about that, and we entered ABX. We went into ABX at a way too high price back in January at 15, and now we're at 13. We just adjusted. Okay, but we love this stock. It just went back down further than we thought it would. So what? We're talking about 2-year plays here. So we adjusted our targets. We're now in a 10-something spread. We adjusted our target, but it doesn't mean we don't like the company. They were down there in December, so I liked them in January. I'm not going to not like them because they went back to 13. That makes no sense. They were just at 13. I thought they were going to keep going up. They didn't keep going up. They went down. I think this ridiculous downturn, but whatever. Alaskan Airline, we love these guys. That was a newer one. When they took this dive here, actually, this is from 1.7. So actually, when they took this dive to 70, we liked them. But I sold the 60 puts. I was pretty conservative. We sold the 60 puts for 620. And then it took a further dive. They went up, but I don't care that they went up because I've got a net $54, $53.80 entry. And we don't, they're in the LTP now. Let's see where they are. Is this the LTP? Oh, we turned it into a full trade. So when it fell, we added to the trade. We only sold 3 anyway. When it fell, wait, this is the OOP. I was going to say, it doesn't seem like I wouldn't have sold just that many in the LTP. Okay, so ALK. Okay, so ALK, we sold 10 puts. We ended up getting 810 for them at the time. They're even now, they're underwater. But the point is, when the stock dropped on 125, we didn't freak out about our puts. We sold the $60 puts for $8. We were going to be in at $52. I really want to own them for $52. I'm not panicking out. Instead of panicking out, I'm saying, oh, what else can I do with this position? I could have sold more puts, but we didn't need to. We already have 1,000 commitments, so that's good. So then we added a bull call spread, and we picked up the 45.70 bull call spread. Now that spread's already up a few $1,000. So, you know, it's the trading, it's about having an actual target and believing your target, not changing your mind about your stock with the win. Like with Apple, I mean, you know, you've got to believe that Apple has a value. It's not random numbers on a page. You have to say, I think Apple is worth this. And if you don't have that premise, I don't even understand how people can trade when they don't have that premise. But I understand that like 80% of you, 90% of you have no premise when you get into a stock, which freaks me out. I don't even understand how people do it. I don't buy a stock unless I know what it's worth. And then I have to be getting it for a good price. Otherwise, I don't want it. Other people, that to me, it's like complete voodoo with this bullshit where you look at a chart and pick a spot on a chart. I don't give a crap what the chart looks like. I care what the company's worth. I want to know how much money they're making compared to how much money I'm giving them. What percentage of that company am I buying, and how much profit are they going to generate for the money that I'm giving them over time? So first of all, are they currently giving me a good return? Do they have good future prospects? Are they on track? Is their history logical? You know, and yes, I do look at the strength of the chart, because obviously if 90% of the people are trading TA, I got to look at the TA. But that's the last thing I consider in making a trade. I look at it for an entry, and that's what a watch list is for. It's say I would love to buy ALK. Obviously, if it's on the watch list, I know it bottomed out here. So when it gets there, I definitely want it. So here we took a put at 60, which was our target. Why was it our target? Because it was below the bottom. I sold the 60 put when it was at 70 because we got a good price, $8. And I said, you know what? For $8, I'll sell that put, because that gives me a great cushion below the price I would love to. I would, you know, it's back here. I say I wish I had bought them here. So what do? I sell the $60 puts. That's like buying it here. I wish I had bought this company at this price. Now I did. Even though it was up here, I sold the $60 puts. Then I take that money. Then as it comes lower, all the way back to my 60 target, it looked like it was bottoming again January 25th, right here. This is us with this big spiking thing. So then I put my foot down and say, now we're really buying into this thing. Now we're buying the $45 puts. I'm sorry, calls. We bought the $45 calls deep in the money. I may as well have bought the stock, except why should I buy the stock when I can buy a spread? It's so much cheaper to buy the spread. Why would I lay out the extra $45? I basically own it. The premium on those 45 calls was practically nothing. So we bought the 2020 $45 calls for $20. So netting about not $20, you know. So netting about 65. So our net price on the stock, well, actually no, netting 63.75. That is important. So we bought it for 63.75. There. As the stock hit 62, we basically put our foot down here. Sorry, the stock came down like that, spiked down. We basically said, I'll pay $63.75 for it by buying those $45 puts for $18. So we put our foot down right here and said, we're going to own that stock at this price. But then I turned around and I found some sucker who was willing to pay me $8 for the $70 calls. So now my $18 becomes an $8 spread, and it's a $25 spread. So I've got a $15 upside, 150% upside. I basically own the stock, and anything over 70 I cash out. Not to mention I sold these puts for 8, so my net is 0. And that's how we worked our way into the stock at a good price. It's not different than the way we just worked our way into gasoline. Speaking of which, $1,200. Yeah, it's still looking good. He's going to stop at 62. Leave it alone. Where are we? So it's not very different than the way we worked into that gasoline contract, okay? We saw a price, we liked it, it went lower, we bought some more. But And I was able to buy some more because my premise on gasoline is that, like I said, by Friday, I seriously expect this thing to be stronger. I'm willing to put my foot down and say, yeah, it's going to be stronger by then. Not to mention we have President's Day weekend coming up. So if worse comes to worse, I hold it until President's Day weekend. That's definitely going to go up by then. So even if it went down lower, I could still hold it for President's Day. All right, where are we? Oh, watch list, right. Never get through this thing. Here's Best Buy. We like them enough to take a play, and they've been holding up okay. You know, a little up and down action, but who cares? And again, they have 2-year plays. You really got to get your head together. It's like, I'm fine with this. And what kind of play did we take? The 1750-25 spread. So when the stock was, what day did we do this? The 18th. So on the 18th, around here, so it's at 22, it was at 23-ish. We took the 1750 conservative, 1750-25 spread. Again, basically, I'm owning the stock because we paid very little premium. We paid $6.60 for the 1750, so that's $24.10. We paid $24.10 for the stock, but then we turn around and sold this idiot the $25 calls for $3.50. I'm in the money. I'm paying $24.10 when the stock's at 23. This idiot's paying $28.50. I'll take that deal all day long. That dropped our net to $3.10, which makes our break even $20.60, which is, look, the low. I didn't know that then. Actually, I did know that then. It was this low. So we bought the stock. We are in the stock for this price, $20.60 net on the bull call spread. Forget the short puts. Just on the bull call spread, we're in the stock for that price, which I believed was the bottom. And our goal is to get to 25, and we're going to make I don't know, a lot of money, at least 100%. Well, I must say that here. I don't know. Anyway, overall we paid, well, say $7,500 spread. We paid $1,700 total for it. So we're going to make I'm doing weird math. Okay, forget it. Anyway, so anyway, it's $1,700 and it's $7,500 spread. So we'll make about $6,000, which is like 300%, 400% on this thing. And all it has to do is get to 25. So if this goes up 10%, we make 350%. It's not hard. And what's our worst case? Our worst case is we own the thing for $1,750. I want to own Best Buy for not Best Buy, sorry, Bed Bath & Beyond. I want to own Bed Bath & Beyond for $1,750. You know, when I said when I said Best Buy, it suddenly occurred to me how cheap $1,750 would be for Best Buy. And here's Blackstone. Blackstone, I was like, how could they not be making money? Now they had a rocky little thing here. Look at this. They fell like a rock in the thing. I didn't know they did that. I would have probably added some more. But we sold the 30 puts. They come down to 30. I don't care. This is 2 years from now. I just think they're going to hold 30 for 2 years. My net entry is 26. It's not aggressive. Cheesecake Factory, I can't believe they're still cheap. 1.7. They're basically back where we came in. And again, all we did, let's sell 5 in the LTP to remind us to keep an eye on them. Because I wanted to, you know, that way we look at them. Every time I do a review, we look at them, and if they're cheap, and this is cheap and not fantastic. This would be fantastic. They come down to here. Now, what happens in the long-term portfolio? I sold 5 of the, the July 45s. We sold July 45s for $2. So we're in for 43. So let's say they go to 40. What happens? Well, my July 45s are 5. That means we're down 3. We're down 150% on our puts if it goes to 40. But what would I do when that happens? All I'm going to do is roll the puts to a longer strike at a lower price, and then I'm going to buy a bull call spread because I freaking love these guys at 40. I'm not going to cry. I'm going to be happier if cake is at 40 and I'm down 150% on my puts, because then I can establish a big position at a great price. I'm going to be happier doing that than I will be just getting $2,000 because I never got a good price. And I know maybe that sounds crazy to people who who are used to making short-term trades and whatever, but this is a different kind of trading thing. We're trading over the long term, and we're selling as much premium as we can. And I can't sell a lot of premium unless I build a decent-sized position. Here's Chicago Bridge and Iron. I think they probably took off. Not so bad yet. But again, we're pretty conservative. We did the 15-25 spread. Okay, so we're middle of the road. We came in here and we took the 15s and we sold the 25s. We're pretty ambitious with our outside, but our break even, we only laid out $1,400 for 10 calls. So we're at 1645 is our break even. And why is that? Look where 1645 is. It's right there. We think that line's going to hold. That's our premise. Anything above that is profit. Quarterlines. Speaking of miners, Quarterlines a miner I still like, and they're still pretty cheap. This was a good trade, and here we're in the 7-10 spread. 7 is way down here. And when did we enter this trade? On 1-3. So on January 3rd, they were here, and we took the 7-10 spread. Whoa, way up there. It's funny how the proportions are different on each chart. So we took the 7-10 spread, and we only spent $8.50, which is 85 cents each. So our break even is $7.85, right where we are now. Anything above that is gravy for this trade. Chesapeake is trashed. Holy shit, still going down. They got a lot of debt and people are just freaking out that they're going to go bankrupt, but I don't think they are. And we didn't buy more of Chesapeake though. We didn't add to them yesterday, but I was waiting to see what happened at the $3 line, but I can't believe they're going lower. So anyway, so here we have the 3-5 spread, but they're now below 3, so we're going to probably look to adjust it. It's a not expensive spread, but it's a matter of we're going to have to make some adjustments here. We have the $4 puts that we sold for 120, so our net is 280. We're getting close to our net. All right, but I can always move that and adjust it. Chimera, weren't we supposed to add these the other day? We were waiting for the sell-off. This is exactly the sell-off we wanted to get in on these guys. So notice there's nothing blue here. We hadn't done it yet. We were waiting for a good sell-off. This is a good sell-off. I love these guys. Cleveland Cliffs, another fantastic one. 1.7 though is way up here at 850. It took a total dive in the last few days. We sold 20 of the $10 puts for 370. Look at that. It's a crazy number. Our net is 630. So it actually hit. That's exactly where it hit. It hit our net, and then it went back up. And why? And by the way, why is that? Because I don't do these at random. I do the math, and I say this is a price I'm willing to put my foot down at. 630 is a price I'm willing to actually buy the stock, or I'm willing to actually. And in this case, it's not so much buy the stock. This is the price at which we should be getting a bull call spread and adding to the position because it got nice and cheap. When I sell a put at a price I actually want to buy it at the value I think I would get in there and put my foot down. And I'm pretty good at valuing things. I used to get paid just to value companies. So it's it's like I pick a price where I always look at it from an LBO perspective. I used to do M&A consulting. So when I look at a company, I always think in terms of like buying the whole company. How much would I pay for this whole company if I had the cash to buy the whole thing? And I look at it and I think about it and I come up with a price, and that's what I base these decisions on. And that takes into account a lot of stuff. Like you look at a company, like what do they really have? What are their prospects? What could I sell off divisions for? What could I expand for? What if I merge with this guy? Who might want to buy me as a company? Who in the industry is doing such? There's a lot of consideration, but you gotta come up with some way to value a company where you know what it's worth, because it makes your life so much easier. And sure, these short puts have got to be losing money. Where are we? CLF. Yeah, they're down 16%. All right, well, not much. So they're down 16%. They're down $1,000. I don't care. Unless it's below 630, I don't lose any money anyway. But it's only on paper I'm losing money. But what I want to do now at this price is buy. I want to add to this position, not subtract. I want to now buy a bull call spread on Cleveland Cliff. Okay, ETE. Another natural gas play. It's a good sideways play to play natural gas. I like these guys, and they're coming down to a price where it's worth buying. Ford, we just pulled the trigger on yesterday, and they're blasting up already. Ford finally came down to where we wanted it. I don't know why I said that. We didn't really add them. I don't understand what happened. I think I meant to add them, or we added something. Oh, I know. We added FTR, and I got it mixed up. FNSR, I love them too. They came down nice and cheap, so we just rolled that position and added to it. And again, we had a position. It got cheaper. It still hit our target. Our target was 17. We're fine with that. We sold the 17 puts. Our target was 17. It came down to our target, so we rolled to a much more aggressive bull call spread. And here's FTR. We love these guys. We came in at 716, and now they're at 779. The thing about them is they pay this massive dividend. They pay a $2.40 dividend. It's like 33% of the stock price. And we keep thinking they're going to cut it. It's ridiculous. You can't pay up, to pay up. But their attitude so far is we don't care. We think the stock price is stupidly low. That's what the owners are saying. They're like, we don't care what the stock price is. The dividend is how much money we can afford to return to our shareholders. We can afford to return $2.40 for our shareholders because we have tremendous cash flow. So why would we not give you back $2.40 when that's how much we made per share? They practically run it like a REIT. They give back most of the profits. And they've got tremendous amounts of debt, but they're a telco. A lot of telcos have debt. AT&T used to have tremendous debt. Verizon had tremendous debt. When you have to invest in 20-year, this is how they get you with these cyclicals. Because when your business is investing in something that pays off over 20 years, like transmission lines and towers and things like that these guys have to buy, and massive data centers that they have to build, when there's no short-term return on that stuff. You're laying out incredible amounts of money, and you're going to make it back 5% per year for 20 years. That's how it works. And hopefully, at the end of 20 years, you have some value left, and that then becomes your profit. But then 20 years later, they start doing it again. Once you pay off the first cycle, if you want to continue your operations going forward, you have to reinvest and re-up and so on and so forth. That's why they call them cyclical businesses. And I love buying cyclical businesses when they're cheap because people can't stand the part where they're building. All the investors run away when they're building, and they all come back when they're up by then. But meanwhile, when they're building, you can buy them for 10 cents on the dollar. Anyway, so I love these guys. GCI also, this is a good one also now. Also hit the range that we were looking at, so I like them down here. GE, we talked about that. GE just gets cheaper and cheaper and cheaper. We came in at 1.7. This one I called way wrong. We came in here, and that's like 19, and now it's down to below 16. And we sold the 20 puts originally. Holy cow! So the 18 puts in the OOP, we sold the $20 put. So we were thinking it was going to easily go up this way, and instead it went this way. So our puts are deep in the money, and I don't think we've adjusted those. I think we're still waiting to see what the hell happens. GE. Oh, our biggest problem here is we never covered. So we have the $15 calls. We never sold the short calls. That really hurt us because we thought it was going to go up. But that's where we are. So we're in the $15 calls in the end. And we have the $20 short puts. Now, these guys, they're really not that bad. They're not hurt that badly because we sold them. Again, because we sold the $20 puts for $3.50, we net in for $16.50. So even at $15.50, it's not that bad. What happens is the premium drained out of them, and now they're $5.50. So they only have $1 of premium left. $14.50, yeah, correct. They have $1 of premium left. At this point, they're not really doing as much good premium-wise. We may decide to roll them to 20 of a lower strike. So in fact, let's take. There's a good example. So we have the 2020 20 puts. That's a lot of 20s. Up. Don't like it, and oil fell, so let's get out. Gonna sell. Thank you. Gonna sell again. There we go. All right, so 1121.40. I'll take that. All right, because why? Because look what oil's doing. Oil stopped dead at 62 bucks, and it's falling back. So gasoline is probably going to follow. And why should I risk this profit? It's almost 1,200 bucks in profit. Why would I want to risk that? It was a nice little trade. You know, don't forget there's 200 trading days a year. So if I'm going to make 1,000 bucks and lock it in 200 times a year, that's $200,000. I don't care if you're rich. That's still money. Nobody sneezes away 200,000 bucks. It's like, why would you throw that away? And again, I am bullish. If it pulls back, I'll be in again for sure. But if it gets away, I'll say, oh well, it got away, but I got my 1,000 bucks, so I'm happy. But I see oil pulling back. I don't know what's happening. I'm not paying attention to the news. And I don't want to take a risk. This guy's flattening out, so maybe he's going to pull back a bit. If it comes back to 176 and they hold it, I'll be right back in. Okay, and frankly, if it breaks over this line, I'll probably get back in also. So we'll see what happens. But right now, when I have 1,100 and something dollars on the table, I'm going to take it off. If I'm in, if I'm even the teeniest, see that's the thing. Once you get a $1,000 gain, or even a $500 gain, once you get a decent gain, once you get a gain that matters to you, put it that way. Once you get a gain that matters to you, you should have the itchiest trigger finger to get out of the trade. You got to learn to take those profits. So comments: gold is going down. It's no longer tied to the dollar, but to currency. What? Why is gold going down? I hear it's no longer tied to. It hasn't been tied to the dollar in years. But to currency, that doesn't make any sense. Gold is just gold. Gold's just an asset class. People trade it. It goes in and out of favor. So for whatever reason, it's out of favor at the moment. Well, actually, the strong dollar is pushing gold down at the moment. Chipotle dropped 11%. Is a good time to double down. I'm not doubling down on Chipotle. I'm watching and waiting on them. I like them. We have a good entry on them, but I'm gonna see what shakes out. They have well, first of all, the problem with Chipotle is I like them, but they're not a stock I would generally buy at that price because they're pretty high multiple. And if they are showing some erosion in their customer base, maybe they're not worth it. But we're right back to where they were. They're right back to where we entered them in the first place when we liked them. Like when they sell off this level, this is where we jump in. When they had their problems in the summer, this is where we went gung-ho bullish on Chipotle. So they're just right back to where we wanted them. So I like them here. I endorse the trade here, but I'm not gonna double down on Chipotle. It's an expensive stock. We're already on the hook for I think 1,000 shares. So I don't want to have too many. Where are we? No, probably not. Probably 5. Knowing me, I think we only sold 5 puts so far because for initial trade. Let's see, CMG. Yeah, we only sold 5 puts. So we're on the hook for 5,000 shares, which is still $130,000. So if we're assigned, that would suck. But I'm not worried about that. Our net, we have the 270 puts that we sold for 35, so our net is 235. So they're at our put strike now, and currently they're only showing a small loss, so I'm not even really concerned about it. It's 22% down. But I'm not looking to spend more money. I might want to roll these calls lower and widen the spread. That is what we did last year, in fact. So we might want to roll the 280s to the 260s if we can do that for less than 10 bucks. That would be the way I'd improve the spread, not doubling down. Doubling down is what you do when you're in serious trouble, but you still believe in the trade. This is not in any way in serious trouble. I mean, the whole trade is 12 and 11 cancel out, 3. So say it's down about $4,000 or $5,000 bucks. The whole trade. It's not a big deal, and the upside on this trade is $30,000. So of the $30,000 trade, it's down $5,000 at the moment. So I'm not too worried about it. Aren't there 4 parts to this trade? CMG. Oh, there's another part to this trade. Sorry. Oh, we're not even down 5,000 because here's a plus 5. We sold these short calls. So we're actually even. So when you're even, why would you adjust? Where do you see BBBY going for the upside target, please? Are you worried about, since rates are creeping up and housing is slowing? No, because it's you know, bed sheets and linens and things like that and disposables. They've got it's a. The reason I started liking Best Buy is because I kept having to go there. You know, especially when not Best Buy, Bed Bath and Beyond. I started liking Bed Bath and Beyond when we had kids, and I found myself constantly going to Bed Bath and Beyond. Obviously, before that, my wife would do all the Bed Bath and Beyond stuff, and I never even knew it existed. But when we had kids, and this is going back 18 years now, all of a sudden I realized like people use the store for everything. It's just a constant need for linens and bedding and sheets and pillows and knickknacks and so on and so forth. And it's kind of convenient. There's something to be said for those kind of stores that, you know, yeah, they sell this stuff at Sears and they sell this stuff at Costco and they sell this stuff in the grocery store. But you know what? It's all that kind of stuff in one place with an expanded selection of all those things, and it's right there in stock, inventory, and good prices. It kind of works. There's some retailers have a good formula. They have a good formula. The same way like Restoration Hardware has a good formula. It's all high-end plumbing stuff that rich people like to look at the sinks and look at the bathtubs and look at the showers, and they don't care what it costs. They just go, yeah, I want that. Let's get it. You know, there's certain stores that work. Williams-Sonoma is another one I like because, again, I'm rich. I go to Williams-Sonoma because like food porn, you know, it's like it's all the best everything of food and all the best cooking things and so on and so forth. And of course, you can get it cheaper somewhere else. And yes, I even know that Bloomingdale's, which is where I used to go before Williams-Sonoma came along. I used to always go to Bloomingdale's to get my cookware because they always had good quality cookware, and they still do. And it's definitely a better price than Williams-Sonoma. But Williams-Sonoma is bigger and nicer. In Bloomingdale's, it's a section. In Bloomingdale's. In Williams-Sonoma, the whole store is all about it. So when I want kitchen stuff, I like going to Williams-Sonoma to buy it. Anyway, so some of those stores to me work. And again, I'm saying it works for me, and it works for people in the top 10% who are not that price sensitive. But that's who they're aiming for. That's the healthy part of the population. If you're catering to the masses, you better be cheap. And you better be cheaper than the other guy, and you better be able to make money at low margins. You know, I wouldn't look. This business doesn't cater to the bottom 90%. This is the top 1% kind of business. Me giving financial advice to people who have money to put in stocks. I chose that 20 years ago because I said this is the only way you're going to make money in the future. You have to do things that people with money want. Because that way you don't have to worry about struggling for every dollar of sales and constantly trying to get people who barely can afford to pay you and things like that. That's not a way to run a business. It's no fun. I've run businesses like that. They're no fun. If you want to have fun, if you want to enjoy yourself in a business, you've got to have a business that caters to people with money. Because they'll come back again and again. They'll spend the money. They'll be loyal if you take care of them properly. You know, this is what you want to do in a business. And I tell my kids that too. I'm like, I said, look, I'm not going to force you to do anything, but what I want you to do is to consider very carefully your career choice in light of the fact that any menial task is going to be done by a robot in 10 or 20 years, and any repetitive work is going to be done by a robot, and you've got to do something that's mentally challenging, that somewhat creative, that your personal interactions matter. And also that in some way, shape, or form you're catering to people who have money. Because trying to figure out how to be a cog in a machine that takes care of the masses is an ugly, ugly thing for the future. And in that light, that's how we make some of these picks also. Now, GE, I'm sorry, this is the stupidest thing in the world. This is me banging the table. Do not have this stock in your portfolio. This is ridiculous. Anyway, so the whole top of the article is about why GE is stupidly cheap, and it got cheaper since then. It's crazy. Gilead, I really like. We sold some puts on them. GNC, I like them. They're a turnaround stock. They're going to take a long time to turn around. We sold the $5 puts for $3.10. Why would you not do this? You have, unless they're going to go bankrupt. We sold the $5 puts for $3.10. We net in for $1.90. I don't even understand why you wouldn't. I don't even understand how that's even possible. Are they still the same price, GNC? No, they're $260 now. Still, so you net in for $240 if you do it now. It's such a crazy price for those. It's just based on a fear of bankruptcy. We are not going to get to all these now, so I'm going to stop here at GoPro. GoPro, I like them. Again, they cater to the rich. They're high-end cameras, and the thing is, though, what I like about it is not the consumer thing. I think that was actually the whole consumer. What they made a huge mistake with these drones. They wasted a lot of money and it killed them. They're just getting back on their feet. We sold the $8 puts for $375. So like GNC, we get a 50% discount buying them. So our net entry is $425. They're testing it. But I feel the value in the company is there at $425 because what I like about them is they're super high-end cameras. Nobody's touching them in that market. They sell $50,000, $100,000 camera rigs that Hollywood producers buy and people buy and professional stunt guys buy and sports teams buy. They've got all these indestructible high-end multi-vision camera setups that like, you know, with the 360 degrees and whatever. Nobody else does that kind of stuff. And they don't have to sell too many of those to make their whole year go well. So that's what I like about them. And I wish they would focus more on that. They got into this whole drone thing, and they realized that they're never going to compete with all the Chinese drone makers and everybody else in the world. And the laws are weird and all this stuff. It's just stupid. So hopefully they get back. You know, and the problem is the consumer cameras, again, they have the same problem, so much competition. They don't have competition in the high end, and so they've got to realize that their future is being like the Porsche of cameras, you know, not to try to be a big consumer company. I think they're starting to get it. I hope they turn it around. So I like these guys. All right, we'll do the rest next week. H&R Block, though, that's important. H&R Block is a great opportunity right here, below 25. Absolutely want to buy them here because once tax season starts, which is now, it's all a matter of thinking. People start saying H&R Block, you start hearing their name constantly. People look at the stock, they see it's cheap, and they start buying it again. It happens pretty much every year, tax season. See, here, look, see what this is? They were way down here, and then May, June, July, as everybody comes back to their accounts, they're like, oh, H&R Block, yeah, oh, didn't they do all the taxes? And they just suddenly shoot up, and then people get bored and forget about them again. They drop off. It's a cyclical every year like that. And it is because they make all their money here. This is when they make all their money. When they report in June, they're reporting the quarter when they made all their money. That's when everybody came to them and got their taxes done. So then after that, obviously the next quarter, they're way down because tax season's over. If it was logical, they would just trade in the middle here at about 28, but it's not. So they trade up. They trade up to 32 and down to 24. So if you buy them when they're at 24 and you get out when they're at 32, that's the way to play the stock. It's really not complicated. All right, somebody remind me where we were next week. I gotta cut this thing out. It's 3:12 already. Holy cow! All right, guys. Are we going to exit GE? No, we're going to buy more GE and more GE and more GE. Do you understand? More GE. This is banging the table literally on GE. We will own a lot of GE. All right, guys. Thanks very much. We'll do it again next week. Take care.